You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome, everyone. If you've been watching the digital asset space lately, you might feel a bit like you've got whiplash. It's understandable.
Oh, definitely. The narrative's shifting, isn't it?
It really is. For years, it felt like, the Wild West, all volatility, speculation.
Yeah, moonshots and memes.
Exactly. But the last few weeks, maybe months, it feels fundamentally different. We're talking foundations now. It's like the digital economy is finally putting on a suit and tie, maybe walking into the boardroom.
Yeah, that's a great way to put it. It's a real inflection point, and the developments we've tracked really capture that shift. It's moving from innovation in silos to, well, almost mandatory integration with traditional finance.
Absolutely. So today we want to give you the shortcut. We've pulled together the key developments across, let's say, 3 big areas: regulation, the underlying tech getting serious upgrades, and how decentralized finance, or DeFi, is changing to actually appeal to big money.
And what's really fascinating, I think, is the tension playing out. You've got the need for speed and innovation that's crypto's core promise, right? Butting up against the demand for compliance, for security.
Yeah.
That's what TradFi needs. And you see this conflict everywhere, starting right away with things like ETFs and stablecoins.
Okay, let's dig into that. Those regulatory breakthroughs first, because they seem to be opening things up for institutional players. The SEC made a really big systemic change recently, approving generic listing standards for commodity-based ETPs.
Yeah, this is a pretty significant procedural change. It basically means exchanges don't need a separate individual SEC review for every single fund application anymore, like for spot Bitcoin funds, for example.
If it meets the general criteria.
Exactly. If the fund structure fits the pre-approved mold, the exchange can list it much faster. That old process, it could drag on for, up to 240 days, 8 months or more sometimes.
A lifetime in this market, and we saw the result almost immediately, didn't we? REX shares and Osprey launched their XRPR, and the Doji E ETF, Duo JE, boom.
Right. And the interesting part is how they did it so fast. They used the Investment Company Act of 1940 for registration.
Not the Securities Act of 1933, which is what you usually hear about.
Correct. The 33 Act is about the initial registration of the security itself, the underlying asset. The 40 Act, though, it governs the fund structure, the investment company.
Oh.
So the focus shifts to investor protection within that fund structure. For digital assets holding commodities, that seems to be a much clearer and obviously faster regulatory path right now. It signals things might be getting permanently a bit easier on that front.
That makes a lot of sense, explains the speed. Okay, moving from funds to the plumbing underneath stablecoins, we see that same tension here, right? Innovation versus compliance. Big global news with Alipay in Luxembourg.
Huge news. Alipay Europe, part of Ant Group, got the green light from the CSSF, that's Luxembourg's regulator, to issue e-money tokens under MiCA.
And MiCA is the big new European framework.
It is. And this authorization gives them passporting rights, so they can launch a regulated euro-backed stablecoin across the entire European economic area. That's institutional scale access right there.
But, and here's the perfect example of the current climate, here's the rub, right? This big approval came just 2 weeks after the same regulator, the CSSF, fined Alipay Europe over $200,000.
Yeah, for serious anti-money laundering and counterterrorism financing failures.
So the message seems pretty clear. You can play in the big leagues, you can have this massive market access, but only if you clean up your act on compliance first.
It's definitely a high-stakes game now. Compliance is the entry ticket. And speaking of compliance battles, look at Tether challenging USDC in the U.S. They announced USAT.
Right, a new U.S. compliance stablecoin. Different from their main USDT offering.
Completely separate. USAT is issued via Anchorage Digital, backed by Cantor Fitzgerald, and they're specifically aiming it at banks, corporate treasuries, the traditional players.
And they mentioned the Genius Act. What's the significance of that for people listening?
So the Genius Act, it stands for Generating Enhanced Network Infrastructure and Unified Solutions Act. Bit of a mouthful, but it's basically trying to create a sort of regulated sandbox. It gives banks, TradFi institutions, a clear pathway to engage with stablecoins while keeping that federal oversight and consumer protection in place.
So USA is Tether saying, okay, we want a piece of the regulated U.S. pie and we'll build something specifically for that market.
Exactly. It's segmentation.
Yeah.
Keep USDT for the offshore crypto native world. Build USHC for Wall Street under U.S. rules.
And all this competition, this push for compliance, it's driving actual use, isn't it? Visa's stablecoin settlement volume apparently quadrupled.
Yeah, up to about $1 billion annualized, they said. But it's not just about, big finance flows. Think about real-world needs.
Like where traditional banking maybe isn't working so well.
Precisely. Look at Ghana, for instance. New banking rules there mean facing like a 5% fee just to withdraw US dollars you hold. Plus, you get hit with unfavorable official exchange rates. So what are people doing? They're bypassing the banks. They're using self-custody USDC wallets. They're swapping into mobile money like on the street to get better rates.
Yeah.
For them, stablecoins aren't some fancy financial instrument. You're just cheaper, better, more resistant to control. The demand is there.
That kind of real-world utility really grounds this whole discussion. Okay, so we have the regulatory wrappers sort of falling into place, but none of that matters if the underlying tech, the pipes, can't handle the volume Wall Street and the world might throw at it. Let's shift to infrastructure, scalability. Ethereum needs a massive boost if it's going to handle trillions.
Oh, absolutely. The official roadmap for Ethereum, they're targeting something like 10,000 transactions per second on the base layer L1. That's a huge leap from where things are.
Okay, so how? The old way. Every validator had to rerun every transaction, right? Which is slow, expensive. What's the magic trick here?
The big shift, the breakthrough, is moving validators away from re-execution towards verification. Specifically, verifying zero-knowledge proofs, ZK proofs.
Okay, I've heard a lot about ZK proofs. Explain it simply.
Right. So instead of every validator doing all the complex computation again, they just check a very small, efficient cryptographic proof that says, yep, the computation was done correctly somewhere else, usually off-chain.
So they're just checking the answer, not redoing the homework.
Exactly. And the beauty is, verifying these proofs doesn't require heavy-duty hardware. They're mathematically verifiable. Someone even showed you could do it on, like, a $7 Raspberry Pi Pico.
A tiny little computer. Seriously.
Seriously. That efficiency is the key. It makes scaling feasible without massive hardware costs, and it's crucial for supporting things like native rail-ups they're building.
Okay, that's the base layer. Meanwhile, the layer 2 scene is just exploding. Base, the L2 backed by Coinbase, hit, what, $5 billion in value, locked?
Yeah, huge growth. And now they're even talking about maybe issuing their own native token, which is interesting because they initially said they wouldn't.
That suggests they're serious about building out their own ecosystem, doesn't it?
It does. But maybe even more practically significant, Base is launching a bridge to Solana.
Okay, connecting two massive and sometimes seen as rival ecosystems.
Exactly, breaking down those walls. The idea is seamless interaction, deposit SOL into Base apps, move SPL tokens back and forth. It's an admission that the future isn't likely winner-take-all. It's multi-chain.
Right, interoperability is key.
And speaking of connections, this leads to something potentially really transformative, the convergence of AI and payments.
Ah, yeah, this is where things could get really interesting, maybe even a bit sci-fi. We look at this angle sometimes on Vocal Technologists, how tech goes from theory to actual use.
Well, it's happening. You've got Google, Coinbase, the Ethereum Foundation, something like 60 other organizations, all collaborating.
On what exactly?
On an open source protocol. The goal is to let AI agents think autonomous software programs send and receive payments, including stablecoins. They're using a standard from Coinbase called BY402 to handle the security side.
Okay, implications for the listener. What does this mean practically down the line?
It means your AI assistant might not just book your travel or manage your calendar in the future. Imagine it handling complex financial tasks autonomously. Like negotiating your insurance claim, automatically allocating funds to investment goals based on market conditions, or even comparison shopping across vendors and making the purchase, all settled securely using crypto rails.
Wow. Okay, that's a big vision.
It is. And this collaboration is crucial because it means they're trying to build the foundation for that autonomous economy with security and, really importantly, interoperability baked in from the start, not as an afterthought.
Okay. We've hit regulation. We've hit the core tech stack getting faster and smarter. Now let's talk DeFi maturation. If institutions are going to come in, they need stuff that looks more familiar, more predictable than maybe the crazy yields of early DeFi.
That's exactly right. Protocols are definitely consolidating, getting more strategic. Look at Aave, still the biggest lender, over $60 billion locked up.
Yeah.
They're actually pulling back support from layer 2s like Scroll and zkSync.
Why? Spreading themselves too thin.
Seems like it. Focusing resources where they have clear dominance, where the deployments are really working, It's about efficiency.
Makes sense. So what's the next step for them? What's in Aave V4?
V4, which they're targeting for late 2025, introduces something called Liquidity Hubs.
Okay.
Think of it like this. Right now, every new market or asset pair on Aave, which they call a spoke, needs to build up its own pool of liquidity from scratch.
Right, which can be hard.
Very. With V4, these new spokes can just draw liquidity from these big shared liquidity hubs. They don't need to bootstrap individually. It makes launching new markets much easier and leverages Aave's overall liquidity depth. It's a big architectural change.
That sounds more capital efficient. But let me push back a bit. We saw some attempts at simplified DeFi apps, like Tori, kind of fail to gain traction with retail users, especially after the FTX and Celsius blowups. People seem wary. They either want super safe TradFi rates or, the crazy risk of meme coins. Why would Wall Street bite if retail is hesitant?
Because Wall Street's needs and motivations are different. They're not primarily chasing DeFi yield farming for its own sake. They need Ethereum or something like it, because their current infrastructure is frustratingly slow. T+2 settlement. It's archaic in a digital age.
Okay, so it's about fixing their own plumbing problems first.
Exactly. And Ethereum's already battle-tested at scale. It secures, what, $1 trillion in assets already? And it hosts maybe 80% of all the tokenized real-world assets out there. The security track record is building.
And the opportunity in tokenizing those real-world assets, especially the less liquid ones, is huge.
Massive. Think about private company shares like pre-IPO giants, OpenAI, Stripe, whatever.
Yeah.
Historically, those have actually outperformed public markets like the NASDAQ, maybe 3x over the last couple of decades.
But getting exposure is hard, right? Illiquid, expensive.
Nightmare. Super illiquid secondary markets, broker fees that can be insane, like up to 10%. So projects like Patagon Markets, Street, others, they're trying to tokenize these private equity stakes, fractionalize them, make them easier to trade, slash the fees.
Okay, I see the appeal there, and this is where those fixed yield products come in as the Trojan horse you mentioned.
That's the hook. That's the critical piece for drawing in traditional finance. Protocols like Pendle are getting really smart about this. They offer predictable fixed yields. We're talking maybe 8% to 15% APY.
Which looks pretty good compared to T-bills at, what, 3-5%?
Exactly. And Pendle does this by taking an interest-bearing asset, say staked Ether, and splitting it into two parts. A yield token, YT, and a principal token, BT.
Okay, like stripping a bond.
Precisely. It creates a structure that looks and feels very familiar to fixed income investors in TradFi. You get a predictable cash flow, a known maturity date via the principal token. It offers that risk profile you understand and demand that makes dipping a toe into on-chain finance suddenly much more attractive, almost irresistible for yield-starved institutions.
Wow. When you lay it all out like that, it really is a period of profound change. You've got the simultaneous push for serious regulation, MiCA, USAT, the ETF approvals happening right alongside this fundamental acceleration of the core technology, ZK proofs making things faster, bridges like Base Solana connecting ecosystems.
Yes, moving on multiple fronts at once.
It really feels like it's shifting from being this niche, almost experimental thing to becoming a necessary and rapidly evolving piece of the global financial system.
And if we just pull back for one final thought, look at what the Ethereum Foundation itself is focusing on now. They're pushing hard on an end-to-end privacy roadmap.
Privacy. How does that fit with all the regulation talk?
Well, that's the fascinating tension, isn't it? They're working on private transactions using ZK proofs, not just for scaling, but for confidentiality.
So at the same time, we see institutions like Alipay and Tether creating these highly regulated KYC-compliant assets.
The foundational layer underneath is potentially moving towards much stronger privacy and censorship resistance.
So what happens then? When the totally compliant, government-friendly stablecoin meets a base layer designed for potentially anonymous transactions.
That's the billion-dollar question, maybe trillion. Does all this regulation bring everything into the light and ensure compliance? Or does it inadvertently push the really sophisticated, perhaps boundary-pushing use cases further towards that trustless private layer, that conflict, that dance between the regulated front door and the potentially private back end? That's likely going to define the next few years.
A really interesting point to chew on. For those listening who want to get deeper into the mechanics, maybe take some time to really understand how ZK proofs work, or look into the details of Pendle's yield splitting. Grasping those nuts and bolts is how you stay ahead.
Definitely worth the effort.
Well, thanks for walking through this complex landscape with us today. Really appreciate the insights, and thanks to all of you for tuning in. We'll catch you next time.
Spoken Tech for your ears.